just recording to the computer. All right, perfect. So this is day one now. Within the next 5 days, this is exactly what's going to happen. So today I'm going to talk about context. So I'm going to talk about the context that you guys should be really interpreting the levels and interpreting, interpreting every part of our strategy within. And the second part of our the second part of the webinar, we're also going to be talking about, I'm going to be zoning into levels tomorrow. So tomorrow I'm going to be going on to charts. It's not going to be a presentation. It's literally just going to be technical chart analysis. And then on Wednesday, I'm going to be talking about the safety trade. So if you guys remember the trading strategy that Brian taught on you guys last time, I'm going to be training you guys on exactly that same strategy on Wednesday, really naming the conditions a little bit clearer for you. And then on Friday, Thursday and Friday, Brian is actually going to come on and talk about trading plan. So that's the one of the most important thing, because of course having a strategy is one thing, but if you don't have a trading plan, how are you going to be able to implement the information that we're teaching you? So on Thursday, Brian is going to focus on giving you guys a solid trading plan that you can use over the course of the year of 2020. So the first thing you understand is context is key. Now, context is very important when you're analyzing and interpreting market conditions, because if you're interpreting market conditions outside of the right context, you're going to be getting bad trades. You're not going to be looking at the right information. You're going to be making really bad decisions. So one thing you need to understand, context is key. And there's three things that we're looking at. When we're looking at context within trading, especially within our style of trading, we're looking at three different things. So the first thing we're looking at is the pattern. That's probably one of the most important things that we look at when we're talking about context. The second thing we're looking at is timing. And the third thing that we're looking at is of course, sorry, that's not supposed to say context, right? That's not supposed to say context. That's supposed to say position. So the third thing we're looking at is the position. So the first thing, so try to take some notes if you can, please, right? So the first thing is the pattern, the second is the timing, and the third is position. Those are three of the most important contexts that we're going to be looking at, over the next few days. So the first one is the pattern. Now, you guys already remember, we taught you guys, the market cycle, moving from accumulation into a stop hunt, into the trend, and of course then from the trend moving into a decimation phase and back into accumulation. But what I really want you guys to understand in all that that is going on is the pattern itself, because if you really understand the cycle, the cycle, you're going to be able to interpret that cycle within different environments. Now, we interpret the cycle on a weekly and on a daily perspective. And I'm going to explain what I mean later on charts. So the first cycle you need to understand is the weekly cycle, because the weekly cycle takes place between 5 to 7 days. Okay, so you're looking at 5 to 7 days of the weekly cycle going from start to finish. Now, what you can see right now, of course, is me labeling, Sunday, Monday, Tuesday, Wednesday, Thursday, and Friday on the weekly cycle slides, right? But what you're not what I want you not to pay attention to is the days of the week. The reason I put days of the week, where I put the days of the week, is because I want you to understand the significance that each part of the cycle would most likely take place on a different day. So for example, you'd have your accumulation taking place on a Sunday, right? So coming when the market opens on a Sunday into Monday, you're looking at an accumulation, and then the next day, the next step, the next stage after that accumulation, you're looking at a stop hunt. And then the next stage or the next step after that, or the peak formation low, sorry. And then the next step after that is you're looking for your intraday trend. And then after that, you're looking at your peak formation high, and then moving into your correction, and then back into consolidation. Right, that's your weekly cycle. Now, this is just a chart showing you guys just an example of how this weekly cycle actually works. So let me just annotate this. Let me just annotate this for you guys so you can see this clearly. So as you can see, this part you can see on the screen, this is our accumulation. Then now from accumulation, we have something called a peak formation low, PFL. Just write that word down, because what terminology we use depends on the context we're talking about. When I'm talking about a peak formation low or peak formation high, I'm referring to the market cycle on a weekly perspective, okay? So another word that we can use for peak formation is an anchor. So ANCHOR is an anchor. So this is the anchor. This is the part where we have our peak formation that's taking place. And then after that, what does price do? Then price moves into our intraday trend, okay? Price moves into our intraday trend. And then after the intraday trend, price then moves it back into, so then we have a peak formation high. So we have another anchor up here where price now forms the highest point within the week from the lowest points within the week. And then it ends the week and then it comes down to correct and ends the week in consolidation. Okay, so this is just a typical example of a cycle. Now, understand this. Why is it important to understand the cycle? Because if you understand the cycle, you know where you are within the cycle, then you know what direction to trade and what direction not to trade. So for example, when I see my anchor take place and I see that, that price is risen for, one level, then the only bias that I have is to go long. I'm only looking to buy. I'm only looking to go long. Under no circumstances am I looking to trade against the peak. And that is a one rule that we have when it comes to trading within the market cycle. You should never trade against the peak. Never trade against the peak formation. Like, that is a golden rule, because like trading against the peak is literally a formula to losing money, right? So when you see your peak formation has been formed, when you see your anchor has been formed, you should never trade against it. You should always trade in the direction of that peak, right? So, but this is just an example of the market cycle. And of course, I'm going to show you guys a lot more examples of these cycle over time. Now, the second part of that we interpret the market cycle in is the daily cycle. So we have the weekly cycle, which would take a period of 5 to 7 days. And then we have the daily cycle. If you guys notice actually on this, these dotted lines that you can see, these are called session breaks. So the dotted lines actually represent when the market opens. So this is a session of market activity. So each line represents the session of market activity. So this is when, the market opens up until when the market closes. This is 1 day of price activity. Now, I don't know exactly what day this is, but let's call this day Monday, okay? And then this is another day of price activity. Again, I don't know exactly what day this is, but let's call this Tuesday. This is another day of price activity. We can call this Wednesday. There's another day of price activity, and we can call this Thursday. There's another day of price activity. We can call this Friday, right? And then moving back the accumulation back into our Sunday, Sunday cycle. So as you guys can see, this takes exactly, the full cycle takes exactly, 5, so 1, 2, 3, 4, 5 days to take place. Moving into Sunday, which you could also count as a 6th day, right? It could take 5 to 7 days, for this cycle, to form. Of course, there are very few variations on this, but on the standard level, 5 to 7 days for the cycle to take place. Now, the second part of the cycle is our daily. 1 second, I'm just trying to move forward. Let's clear that. Perfect. Is the daily cycle. Now, the daily cycle takes 24 hours. That's why it's called a daily cycle, right? Because it takes a day, to form. And the daily cycle would begin with an Asian range. Now, the Asian range usually would take place within Asia, within the Asia session. I'm going to talk about the timing in a very few minutes. But you have the Asian range, right? So this is usually the start of the day. And then when the London market opens, you would expect something called a stop hunt. So price to move in the opposing direction of the intended trend of that day. And then after that, you then get the trend for 3 levels or sometimes 2 levels. Sometimes you even get a 4 levels, trend on the day, right? And then you have your New York reversal. And the reason it's called New York reversal is because it takes place within the New York session. So anytime from 1 p.m. up until 9 p.m. when the New York market is open. And then it goes back into the Asian range, right? So then it goes back at 10 p.m. back into, New York closes at 10, so 10 into our Asia range. So really understand this daily cycle. So this is just an example again. This is on, I believe this was on Pound USD or Euro USD that I took this from. But this is just an example of a typical cycle. So the shadow box, as you guys would know by now, represents Asia. So the shadow box represents Asia, okay? Now, this is the blue shadow box. So you guys can see, price comes outside of a blue shadow box. This is our range, our Asian range. So all that means is price is just moving within a range, okay? And then after that, price then within the London session, we see price coming down, and we see a W forming within our London session. And then what happens is around the time when New York open, we're seeing the trend is actually going to be starting. The trend is now reaching its peak within New York. So we're seeing the trend reaching its peak, price reaching its peak of the high of the day within New York. And then we have a sharp reversal. And then price goes back into our Asia, range. So this is an example of a typical daily cycle that price moves. Now, does price moves like this every single day? Of course not. There are variations of this. Are there instances where, price will come out of Asia and then go into the trend? Yes, there are. Are there instances where price would trend in Asia and then consolidate over the course of the day? Yes, there are instances where that takes place. So there are variations that will take place 110%. Like I said, the market is a very dynamic environment. But what we're doing here is we're defining clear structures that takes place. Clear structures that have repeatedly taken place in over the past many, many years, that the market has been around. And if you can identify this, even if this structure only happens twice or 3 times a week, this structure is going to present opportunities that you can then take place trades, and actually make profitable trades from these structures. So often, do all pairs have a daily cycle starting at the same time? They all range during Asia, ADJ, both in Australia. That's a great, fantastic question, Carl. So do all pairs range during Asia? Well, if you're looking at pairs that like the Australian dollar related pairs or New Zealand dollar related pairs, right? Because obviously during Asia, these are when these pairs have the most volume. These are when these pairs have, a lot of activity. So a lot of the time you're going to find that the Asian pairs, like the Australian dollar, the Kiwi, all these pairs would probably be trending or moving during Asia. But what you'd find is that for the pound and the euro pairs, you'd find that they would be ranging, during Asia, and then during the London daybreak, or during when the London market opens, that's when you're going to start seeing a lot of price activity. So, Carl, that's a fantastic question. Like the pairs, you need to be, of course, conscious about the pairs that you're trading and when you're trading. That's why context is key, right? And that's where timing comes into place. Because if you're trading the right pair at the right time, you're going to see the right opportunity present itself. That's one of the reasons why personally, I mainly trade either pound or euro pairs. And, Brian himself mainly looks at pound or euro pairs. The AUD, the Kiwi, all these other pairs, like they're fantastic pairs to trade. You will find these cycles within those pairs. You will find, these daily cycles taking place within those pairs. But they have the nuances, and you just need to study those pairs to understand what those nuances are. But moving forward from that, Carl, I hope that answers your question. Now, the intraday trend. So the intraday trend is a trend that takes place anywhere from 3 to 5 days, okay? Now, let me explain to you guys what I mean by this. Now, intraday, what does the word intraday mean? Intraday just means something that takes place across multiple days. So something that takes place across, different days. So it doesn't just happen within one day. It happens across multiple, different days. And that's an intraday trend. Now, within an intraday trend, we have something called an LOW, so peak formation low, like I mentioned before. So this is the low of the week. And then we identify 3 levels coming off the low of the week, or sometimes 4 levels, but we identify 3 levels coming off the low of the week, and then going into the high of the week, or HOW, and then ending the week, of course, in a correction, or it could be a reset or whatever. But you need to understand the core part of an intraday trend are the levels. And that's one of the reasons why a lot of your time really studying this technique is going to be into identifying levels. And I'm going to show you guys how to really identify these levels using, moving averages. That's one of the key components in identifying these levels. Of course, you can also use TDI to identify these levels, but moving averages alone and really understanding how to use the moving averages and also understanding how to read candlesticks will help you, to identify these levels. So with the intraday trend, what you're looking for is you're looking for opportunity to actually place, to trade within the trend. You're looking for opportunity to get in at level 1, to either trade from level 1 to level 2, get in at level 2, trade from level 2 to level 3, or you could even trade the correction downwards after the 3 days of rise. So there are multiple different types of trades that we're going to be teaching you guys over time. Each trade has its own character. And we're going to be able to teach you guys how to identify the confirmations for these type of trades that you can trade across the different levels. But for now, what we've shown you guys, if you guys remember clearly, is how to trade from the level 1 consolidation into level 2, how to basically capture this move. So this is what we've shown you guys. We've shown you guys how to capture this move, right? And for a lot of you that forgot this trade, we're going to be obviously explaining to you guys again, later on this week. So I'm just going to draw a circle around it. So we showed you guys how to capture this move, right? How to identify your peak formation low, how to identify a level 1 trade that's taking place, and then how to get your entry anywhere from down here, and then just trade a move all the way up, take your profit there at the end of the day, and you're done for the day. Like, even just knowing how to trade this move alone, you're probably going to be able to place 2 to 3 trades a week across multiple different pairs. So we're going to obviously show you guys how to identify these trades, but understand the different types of trades that you can place within the intraday trend. You just need to find one type and master that one type before you begin to learn the other types of trades. Okay, so before I move on to the charts, I just want to cover something else as well. So what I'm going to talk about with you guys tomorrow is going to be timing, the importance of timing. Timing is key. Timing is the second context that you're looking at. If you're identifying M's and W's without looking at the time that an M and W is taking place, then you're identifying M's and W's outside of the right context, right? So understand your market sessions. You need to understand your market sessions. You have the European session, we have the American session, we have the Asia, and we have the Pacific session. These are 4 of the main trading sessions that we have in the world. And within Europe, we have London and Frankfurt. These are the 2 biggest financial centers within Europe. Understand the time. Know that the London session starts at 8 a.m. GMT our time, right? So 8 in the morning is when the London session begins and closes at 5 p.m., right? And then if we're looking at America, we're looking at New York and Chicago, but New York is what we look at the most. New York opens at 1 p.m., right? And closes at 10 p.m. And Asia, we're looking at Tokyo and Hong Kong, but Tokyo is one of the biggest movers within the Asia session. So from Asia, we're looking at from midnight to 9 a.m. in the morning. And then finally, we're looking at Sydney in Australia, which opens at 10 p.m. our time and closes at 7 a.m. in the morning. Really get to understand these sessions, understand when they begin and understand when they end. But more importantly, what you're going to find over time, especially when you really understand how to trade this technique, you're going to begin to have a preference of when to trade. You're going to say, you know what? I just want to trade a London session, because the London session presents a lot of opportunities for you to make money. So you may just prefer to trade the London session between 7 a.m. and 12 p.m. and you're done. You're done for the day. Or you may prefer to trade the New York session. So you may not trade in the morning. You may just look at the charts and analyze the charts in the morning, but you're looking for entries. You're looking for opportunities to trade in New York. anywhere from 1 p.m. up until 10 p.m. So you're going to find that over time, you're going to develop a preference of when you need to trade. And that's very important that you do develop that preference. It's important that you develop the preference of when to look at the charts, when to sit down, and when to trade. Okay, but for now, you really need to identify the structures and the patterns within the right context, within the timing that we're going to be showing you. And these are the relevant sessions that obviously we've shown you so far. So the first is our Asian session, right, which is Sydney and Tokyo, which takes place from 10 p.m. up until 9 a.m. Now, we don't trade Asia. You know, we don't look for trades in Asia. We're sleeping in Asia, right? You know, a lot of us are sleeping, you know, within Asia. So we don't trade Asia. You know, I'm not going to be up at 3 in the morning looking to make money, or I'm not going to be up at 6 a.m. or no, not 6 a.m., at 2 a.m. looking to catch pips. And you shouldn't be either. You know why? Because a lot of the time, especially for the pound and the euro pairs, which are the pairs that we focus on, they're very quiet within Asia. So they consolidate in Asia. Now, coming out of Asia, we have the Frankfurt and London. So European opens 1 hour before London. So European session opens at 7 a.m., right? And we open at 8 a.m. So 7 to 8 a.m., that's really when you're really going to start seeing a lot of major price activity taking place, especially within the pound major, right? So you're going to be seeing the stop hunts taking place, right? So anywhere from 7 a.m. up until 12 p.m., you're looking for the first period of price activity taking place. And then the third session that we've shown you guys is the New York session. So the New York session is between 1 p.m. and 10 p.m. You know, that's when you're looking for your trends. You're looking even sometimes for your reversals, you know, but that's another time, another opportunity for you guys to look for entries. And if you guys remember the template that was given to you, you know, you're going to see blue shadow boxes around the session. You're going to see a blue shadow box, you know, when Tokyo begins and when Tokyo ends. So you're going to see a blue shadow box ending from 10 p.m. up until, you know, 7 a.m. in the morning, right? And then you're going to see also a shadow box during New York. You're going to see a shadow box within a London session as well. It's very important you guys use these shadow boxes to make decisions, you know, on the trades on the patterns that you're finding. And finally, the most important thing is positioning. Positioning is so crucial. You know, positioning is the filter when we're trying to identify the right opportunities. And the two things we use with the two positions that we look for. The first position is the positioning of the exponential moving averages. So if you guys remember, the EMA is one of the indicators that we use. So, and in the EMAs, there's about 5 indicators that we use in the EMAs, from the 5 EMA to the 13 to the 50 to the 200 and 800. And 5 is not really something that is the most important, but from 13 to 800, these are the most important exponential moving averages that you're going to have on your templates anyway. So you need to have these moving averages on your charts at all times. And what I'm going to show you guys is how to really read the trend, because the EMAs are very useful when it comes to identifying the level, you know, that you're in. And then finally, you need to learn to read the positioning of the RSI and the volatility band and the signals and the dynamic midpoint within a TDI, the Traders Dynamic Index. And, you know, of course, in the workshop, we showed you guys how to use the TDI to identify, you know, a confirmed M and a confirmed W. You know, so we showed you guys how to use a TDI to identify confirmed M and a confirmed W. And I hope you guys remember how to identify confirmed M's and W's. You know, I might show you guys a little bit about that later on, but really and truly the focus on these 3 days, from my end anyways, is really showing you guys how to identify, you know, the levels. So that's it for me. Now, what I'm going to do, I'm going to jump to, I'm going to go to the charts, but before I do, does anyone have any questions? Does anyone have any questions? If you do, you can either unmute yourself and ask the question, or you can just type it in the chat box. All good? Fantastic. All right, so let's move on to charts. Oh, good. All right, guys, just give me a minute. I'm just putting up, just setting something up to pull up. All right, now, a lot of your analysis, right? A lot of your analysis, a lot of your practice should take place on MetaTrader 4, right? A lot of your analysis should be taking place on MT4, especially with the template, that was given to you guys by Brian, right? This template is, very, very high level stuff. So it's important you guys really learn to use the templates and understand it. But what I'm going to do, so I'm going to be using MT4 from tomorrow when I'm going to be doing a lot more detailed training on identifying levels. But for now, when it comes to identifying the cycle, I'm just going to use TradingView. I'm going to use TradingView today. But from tomorrow, we're literally going to be sticking with MT4 so that you guys can really learn and get used to seeing the templates being used. Okay, so first is first. Let me just make my screen full. All right. So the first thing you need to understand, especially when it comes to identifying the cycle, identifying where you are within the market cycle, is you need to learn to identify your peak formations. You need to learn to identify your peak formations low, and you need to learn to identify your peak formations high. Now, one of the things that have really helped me to identify peak formation low and peak formations high is two things. The first is the RSI. So what I look for in the RSI, look for the RSI moving into extreme points. So the extremes on the RSI are moving into the 20% level or moving into the 80% level. These are two extremes on the RSI. So the first is 20% and the second is moving into the 80% level. That's the first thing. The second thing I look for, is my moving averages. So you look for periods for points on the charts where you see the moving averages are fanned out. Because when the moving averages fan out, that is an indication that price isn't level 3. So price isn't level 3 on an intraday trend. So when you're able to identify a peak formation or a level 3 formation, then from that level 3, you're able to then move into the intraday and identify 3 levels from that into the next peak formation high. That is going to be your anchor in identifying the market maker cycle. So I'm going to show you guys this very simple example. It's going to be on Euro USD. So let me just zoom into this. All right, so now where are we when it comes to positioning within a cycle on Euro USD? Well, let's first of all identify the previous cycle, the previous movement, from the previous cycle. So the previous peak formation low on Euro USD, if you guys can see it, is exactly within this region. So I'm just going to draw a square or a box around that area right here. The first thing, of course, the first proof of that is the RSI. So the RSI, which is the green line on the TDI, is at a 20% level. So the RSI is at a 20% level, is in an extreme. So that's the first thing that we're looking at. Now, once you've identified your peak formation, the next thing you're, of course, anticipating is for price to then move for 3 levels. So, of course, if I'm just going to pencil this in, you have price coming out of your accumulation year, and the price going down into your stop on, forming a W. So that's the first leg. That's the second leg. Now, once you have your W formed, we have your level 1, come down, pull back, for another stop on low. We have a level 2. We have another pullback, and then price moves into a level 3 region, right? And then we have an M. So we have 2 legs. It's leg 1 and leg 2. And then after the M, we have a correction downwards. Now, once you have that, the price then goes back into consolidation. So this is a cycle. This is one full cycle. Now, after the cycle is over, there are 2 things that you anticipated. You're anticipating number one, a reset. So let's imagine that you've seen price do this. So let's imagine that you've seen price come out of a peak formation low and it's moved up for 3 levels, right? And it's formed an M and it's come down to correct. Now, the 2 things that could happen. Now, the first thing that could happen is for price to reset and to carry on moving in the upward direction, to carry on trending up. For another 3 levels, 2, 3. And then do the same thing again. So this is a prolonged uptrend, right? So that's the first move that you can anticipate, for price to reset and to keep on trending up. The second move you can anticipate is for price to go back into an accumulative phase. So this could usually, the price could accumulate for a day or 2 days or 3 days, doesn't matter, but expect price to go back into a phase of accumulation, and then you have another stop hunt to the high, right? So this is gonna go back towards the high that it created before. You're gonna have 2 legs, and then it moves down for 3 levels. So these are 2 different possibilities that would occur, and this would form in itself a new cycle. So this is a new cycle. So this is cycle 1. This is cycle 1, and this is cycle 2. Now, does anyone have any question in relation to this? If this makes sense to you, just drop a number 1. If you have any question, you're more than welcome to unmute yourself and ask me the question, or you could just put it in the chat box. It's very important you guys really understand this.
On that first cycle, when you are identifying the W's and the M's at the high and the low, how did you know where the W was? Because I would have picked a different W or a different M if that was me. And like,
on which one?
Go from level 2. On the example you found on the chart.
On Euro USD.
Yeah, so you picked the W. So if you draw your legs that you picked, and then there was that kind of dip in the middle. I picked that as a leg.
So you would have taken this as a second leg.
Yeah.
And you would have been absolutely right. So this could have been, so this is a three-legged W. So you would have been right. This could have been a second leg, and then it retested that low before taking price away. There's nothing wrong with that.
Right. And then when you got to the top, like if I was trading from level 2 to level 3, I wouldn't know when was my peak almost. Like at what point do you reach that level 3 peak? Because there's a lot of like noise up there that I'd get thrown off by.
Yeah, there's usually a lot of noise at peak formation. So there's usually a lot of noise at level 1, and there's usually a lot of noise at level 3. So now let's imagine this. Let's imagine this was real time, right? And you saw this as your first leg, and you saw this as your second leg, right? So you took the trade, so you waited for price. So this is where moving averages, let me just bring up the moving averages, right? Perfect. So you waited for price to close above the 13, which is the rule that we taught. So price to close above the 13, and then you take your trade from there. So you place your buy order, you probably place your stop loss there, you place your entry there, you place your stop loss down here. Now you wouldn't have been stopped out of this trade. So on the following day, price would have come back down to retest but not break. If you notice, it retested, but it didn't break the low of the previous day. And then it took off. Right?
Okay.
So you wouldn't have been stopped out of that trade. You'd have made a decision based on the same principle, and you would just have to wait for an extra day to see the result of that decision. Now, in terms of a peak formation high, remember what I said. So peak formations, one of the ways to identify it is using RSI. So if your RSI is in an extreme region, so above the 80% or below the 20%, you're in an extreme region, right? So in this situation, after the three levels that are taking place, so let me just draw the levels again for you. So level 1, level 2, and then you had the third level rise right there. And then it came down to close below the 13. And then you had a second leg. So because usually at level 3, remember at level 3, you're going to get 2 legs, right? Level 3, you're going to get 2 legs before it either corrects or resets. So you had the first leg there, you had a second leg there. Now, how would you have known that, for example, price was like the second leg could have just come up here and reversed down here, right? But remember what we told you, you always wait for the confirmed entry. So you would have waited for price to come down to the and close below the 13, to close above the 13, and then close again below the 13. And if you had still waited for those exact same confirmations, you would have had your entry exactly at that point. Does that make sense?
Right, okay.
And exactly from that point, price rolled down. But also watch this as well. Watch what's going on the RSI. Now, in this region, and this is called divergence. In this region, price is going in an upward direction. Now, if we look at those exact points on the RSI, what can you see? What direction is price moving on the RSI?
Yeah, going in opposite directions. So
going in the opposite direction.
In the trend.
So this is called an RSI divergence. And RSI divergence is also another solid confirmation of, when you're within level 3, you'd usually see a huge divergence, right, in price movement. Let's go down, down here as well, right? You see a lot of divergence when there's a lot of price activity taking place. So always keep an eye on your RSI. Keep an eye on the RSI. If you see something like this where price is pushing higher on the candlestick, but on the RSI price is pushing lower, then you know that a reversal is imminent. All you need to do is to wait for that confirmed entry, wait for that close, below the 13 EMA. And then once you get that close below the 13, that's when your trade begins.
Awesome. Cool. Thanks, man.
No worries. Does anyone have any other questions?
Walter. So your RSI, is that going to change depending on what time frame you're in?
Yes, it does. So it looks different in different time frame.
So is there a preferred time frame to be looking at your RSI reaching level 80?
Yeah, I mean, so I'm on the 1 hour now. 1 hour is the preferred time frame to identify levels in, especially if you want to be looking for day trading opportunities. 1 hour, 15 minutes, those are the 2 time frames that you would mainly use to identify your levels within.
Okay, cool.
Does that make sense?
Yeah, that's good, man. Thanks.
Perfect. So when you're identifying your intraday levels, you want to make sure you're on the 1 hour charts. Does anyone else have any questions?
With this, when you zoom out, or so when you'd scroll and look at a bigger picture of time, your RSI your levels would change. So in this snippet we're seeing now, 80 may be that point. Then when we zoom out, a bigger peak might make that 80 look like not a high level. Do you know what I mean?
So can you explain what you mean?
So like if we zoom out, will the 80 peak that we just looked at remain still an 80 peak? Like would it still remain at 80 or would it shrink down? Do you know what I mean?
No, it's still exactly the same level. So zooming in or zooming out doesn't change the position of the RSI.
Oh, okay, it doesn't change.
Yeah, it's still the same.
Okay.
All it does is just makes things much more squished together.
Just compress it. Okay, awesome.
Does that make sense?
Cool. Yeah, thank you.
Perfect. No worries. Now, does anyone else have any questions? Guys, it's very important you understand how to identify the pattern, right? Tomorrow, I'm going to go into, so running out of time now, but tomorrow I'm going to go into, and tomorrow it's going to be a little bit longer. It's going to be just about an hour and a half. And I'm going to go into identifying the levels, because the most important thing is identifying level 1, level 2, and level 3. So tomorrow is literally just going to be about identifying levels. But today I wanted to talk to you guys literally about the context, which is the most important thing. Always interpret your M's and W's within the right context. You know, don't be looking at, for example, let's go back to Euro USD, right? You know, you're looking at a situation where you've had a peak formation low. So right now, let's look at this, what's going on right now. So right now, what level? So I'm just going to throw this question at you guys. Just based on what you can see on Euro USD, what level would you say Euro USD is on right now? Does anyone answer the question? So based on what you can see on right now on the screen, what level do you think Euro USD is on right now?
Oh, so I think we've just come out of level 3. So you got that, the EMA fans, and then there's that kind of drop in the RSI just before we start coming back up.
Fantastic. So let me just draw this out in boxes so you can see this clearly, right? So as you can see, we've had a peak formation up here, right? So we've had the level 3 formation up here. So we've had the first leg, right? And we've had the second leg right up there. Now, after that, what we to anticipate? Level 1. So we had a level 1 drop down there. To confirm the level 1 drop, which I'm going to show you guys in more details tomorrow, we had the 13 and the 50 EMA crossover. So this crossover right there. That confirmed that our level 1 is taking place. And then after the level 1, we had price pullback, and then we had a level 2 drop. Now, what happened after level 2? Price went back up to level 2, not to level 1. This is called a 1-2-1 move, right? Before then dropping into our level 3. Right, for then dropping into level 3 and then forming a peak formation down here. And then after that, price then moved up. This formed a second leg. It came down, and now price is actually in level 1. So as you can see, we've had a 50 and we've had the 13 crossover right there. So this is actually a level 1 move, now moving into a level 1 consolidation, and then we're looking at, of course, a level 2 move tomorrow. So this is like the level that Euro USD, from what I see, from what we've seen today, that's taking place. You know, we see Euro USD is actually now within a level 1 formation, moving into level 1 consolidation. And a big evidence of this is, of course, the crossovers of our 13 and 50 EMA. So guys, if that makes sense, drop a number 1 so that I know that you're still listening and it's making sense to you. Perfect. So the second thing we're going to cover now, tomorrow, is we're going to be covering levels. And I'm going to be explaining to you guys the rules of identifying level, because I know someone specifically requested, I believe it was Carl or Brad, requested, or Lewis, or one of the three, requested in the WhatsApp group that a webinar on levels. So tomorrow I'm going to go into a lot of details on levels. But guys, tomorrow's webinar is going to start at exactly 8 p.m. Please try to plug in on time. It will be a little bit longer than this one because tomorrow's going to be a little bit more detailed. And if you have any more questions in the meantime relating to what I've just showed you, drop it in the WhatsApp group or personally message me. But what I advise a lot of you guys to do tonight before you go to bed is go on some of the, the majors, the currency majors, and identify what level it's in right now. Identify where in the market maker cycle, where in the weekly cycle price is in right now. And then just draw it out on your charts, like write it down on your notebook. And then after tomorrow's session, after what I show you guys tomorrow, you can do exactly the same analysis again and see if you actually get the same answer. So tonight, go to your MT4, go on all the currency majors, mark it down, analyze it, see where you are within the market cycle, and also identify what level price is in right now. And then after tomorrow's webinar, look at those exact currency pairs again and see if you reach the same conclusion that you're going to be reaching tonight. So on that note, guys, that's it from me. Have a great night, and I'll see you guys tomorrow at 8 p.m.
Awesome. Cheers, man. Thank you.
Thanks, buddy.